All right. I think it says we're live and broadcasting to all attendees. Uh, Welcome back to the monthly market update, Ibrahim.
Great to be back, Craig.
Yeah, good in Chattanooga. So we dive into the data and interpret what's happening in the freight market. Excited to do this right in Chattanooga. This is the first time we've hosted it live on Instagram. And so this is actually streamed video. If you're curious what we look like when we do this, then you can actually see it live. Otherwise, you can listen in, and we're going to go through the deck today. Real quick, I'm Craig Fuller. I am the CEO and founder of FreightWaves, and Ibrahim is our chief economist. So a little bit about FreightWaves is we are building a community and have built a community that utilizes data technology to understand, analyze, react, forecast, and then ultimately de-risk the freight market. We've got an extensive team, growing team. We're growing about 4 people a week.
Every time I come back up here, it's new faces.
You know, my wife, who used to be here and then took off for when we had a baby a couple of months ago, says every time she comes in here, she's like, I just don't know half the people here, which has been true and it's been fun. But just a little bit about us is we've actually put 30 reporters. This slide's out of date. When we bought American Shipper, we actually have some additional resources in here, particularly on the BCO and shipper side. We're excited to have them here. And we're just growing in terms of the depth. So we bring in a lot of technicals that come from the market, tribal knowledge to describe experience, and ultimately inform it with data. And so Ibrahim is an economist. He looks at it from an economics lens of the PD. I look at it, what folks in the market are driven and a lot through sentiment, things that we're seeing and hearing about them.
So going over the agenda, I'm going to start by just a quick view of the first half of the year. I think there are a lot of developments on the side of the economy during the first part of 2019, and then taking that and explaining what the outlook, a lot of the things drive freight demand for the second half of this year, to the hour, the dynamics are interesting within the have implications for freight. And then Craig will talk about some of the freight market trends that he sees in it. So just as a general summary, I think when you look at freight demand overall, it looks like it's basically stalling, and it's been that way for most of the first half of the year. Most of the key drivers, both on the production side and the demand side, are either showing flat, slightly negative, or slightly positive growth. And so when you take it from a volume perspective overall, most things look basically flat. Manufacturing and trade have been doing particularly poorly during the first half of the year. Retail, again, it's growing fairly well, but it's important to notice that a lot of that is really just e-commerce driven. If you strip out e-commerce from the rest of retail, the picture looks a little bit, quite a bit different. Within the trucking industry, hiring has flattened out quite a bit after a strong year of hiring in 2018. And all of that is putting downward pressure on rates. You have sort of demand that's flat and capacity that expanded last year, and it's put downward pressure on rates in the industry.
You know, one of the things that you're talking about, and we'll talk about flat hiring, but one of the things I'm hearing from a lot of the larger carriers is that the driver shortage, if you will, has actually become a surplus. All their trucks are filled. And so it suggests a flight to quality opportunity where drivers are seeking out companies that can keep them running.
Sure.
And I think if you're if you're a carrier and you can demonstrate to a carrier that you can keep the driver running and give him miles, I think you're going to have a more favorable ability to hire them. So a little bit about what I'm going to talk about is what we call the great bleed off, which has already started. We had 6 major or sizable bankruptcies in the trucking market this year. And we're searching for the bottom. In other words, if we're going to ask the question, a economic recession is certainly not here, and we'll talk about whether you think that's capable. But if, you know, the view is if the economy, the broader economy holds up, then we may just churn through some carriers, eliminate it, and then come out much stronger in 2020. We'll talk about that. And then in capacity is really in the month of July is as loose as it's been all year, which is really unfortunate. We're seeing that specifically reflected in our rejection rates as they hit record lows.
Okay, so digging into the economic side of things, this is U.S. GDP and where the forecasts are for the rest of the year. You can see right now, the last available data point is still the first quarter, which showed 3.1% growth quarter over quarter, 3.2% year over year. Second quarter numbers are going to be out this Friday, right? So you'll get like an initial read for where the second quarter came in on Friday. I expect it to be quite a bit slower. Like I think the growth rate is going to settle in somewhere uh, slightly below 2%, and the year over year growth rates are going to start to come down. So I think like this above 3% growth that we're seeing year over year going to start to come down just in general for GDP. The comps get tougher, and I also think the momentum is the economy is starting to lose a lot of steam overall. Now, over the past couple of webinars that we've done, I've talked quite a bit about GDP and why I don't think it's necessarily the best metric to use when trying to analyze the freight economy, because there's so much additional noise that's in the GDP numbers that isn't necessarily relevant to freight. And so I talked a little bit about just sort of adjusting the GDP numbers, stripping out the services from GDP, keeping the imports in, and like instead of just disregarding imports as being not part of domestic product. I think import volume is also important for freight activity, so I leave those numbers in there. And so what you end up with is just like an adjusted GDP number, and a couple of things that you sort of bring out from this sort of the patterns that we see here. One is that once you adjust for just looking at the good side of the economy, you can see the kind of strength that the freight economy experienced last year. So if you look at the year-over-year growth rates, I mean, you're talking about year-over-year growth that's above 5%. At this time, GDP was growing about 2.5 working its way up to 3%. So the freight economy was growing about twice the speed of like the overall economy. It was a decent economy last year as well. But for freight, it was considerably better. But it's been coming down quite a bit since then. And now the pace of growth that the freight economy is experiencing is slower than the overall economy year over year. And I think when the second quarter numbers come out, you're going to start to see numbers that are below 2% year over year. That's very similar to what we saw in 2016, right? So when the last time there was a freight recession in the economy, the good side of the economy grew about like 1.5% year over year. And there were quarters where goods activity just declined outright.
This real goods number, is that something that comes from the government or something that you built?
Well, it comes from the government, but it's just sort of like I rearranged it a bit.
So you use this as a methodology to say this is really what is driven by freight. You're taking government data and cleansing it in a way that says this is what you believe the freight market looks like in terms of expansion.
Yeah, exactly. Like basically, I take all the shortcomings that I think the GDP brings in terms of being relative to freight, and I adjust for them. So I strip the services out. And again, like I don't subtract the imports out because I think imports are also important. And what you end up with is this adjusted GDP number.
Now that 2.69% is year over year growth.
Yes.
Now I have said, and then we've had some debate about this, is that the freight market is headed into recession if it's not already there. 2.69 certainly doesn't suggest that.
Yeah. So part of it is I would say look at the areas that are growing. So for example, like a lot of this stuff is just like consumer spending, like retail spending. And then within that, a lot of it is going to be like e-commerce kind of activity. So, it's things that you might not necessarily feel as much on the freight side of things. The things, some of the key areas like business investment in structures and equipment, they're barely growing as of the first quarter. And again, when the second quarter numbers come out, like I think it'll look quite a bit worse.
Yeah, it's interesting because like UPS blew out their numbers today.
Oh yeah,
I mean you're I think you were there.
Yeah,
so
that's right.
Certainly rooting for
right.
Big Brown, but it suggests that, to your point, e-commerce and consumer, anything related to the consumer, is actually doing quite well.
Yeah, exactly. It's one of the things I think has been one of the sort of more resilient to some of the other trends that you're seeing on the freight side of the economy. So digging into freight, this is industrial production and manufacturing industrial production. So total industrial production, that's the white line. The green line is manufacturing. And this is levels. Typically, I usually show year-over-year growth rates here, but this time I thought it would be important to show what's going on with just like the actual activity here. On the manufacturing side, you can see basically like the first part of this year, there were steady declines in manufacturing activity, like January, February, March, April. Were all show just declining manufacturing activity. Now, May and June numbers have been a little bit better. Like the past couple months, you've seen increases in terms of manufacturing, but still, you're well below where we started the year off. And if you were actually to sort of aggregate it up at a quarter level, manufacturing declined in the first quarter, it also declined in the second quarter. So, when you're thinking about like this idea of particularly weak freight activity, keep in mind that manufacturing overall has declined both quarters so far this year.
And manufacturing is huge, and particularly certain like flatbeds and stuff that are really largely more exposed than others.
No, absolutely. And so, and as you go forward through the rest of the year, I do kind of expect that this upward trend that we've seen over the past couple months is going to continue. But the trouble is
upward trend in manufacturing and growth.
Yeah, like the gains that we've seen over the past couple of months. I kind of expect manufacturing to be slightly positive through the rest of the year. The problem is like the comps get tougher also. Like third quarter of last year was a really strong quarter for manufacturing. And so when you're looking at like year over year growth numbers, I expect them to stay pretty close to flat. And they may, they'll kind of teeter between negative, slightly positive, slightly negative throughout the rest of the year. I don't expect it to really change until you get easier comps towards the very end of the year. And so, when thinking about sort of freight demand in year over year terms, manufacturing is basically flat, and I expect it to be basically flat in upcoming months as well. And so, just to put some color behind this, I like to show this chart of factory orders in part because it's a forward-looking metric, and it's one of the things, sort of at the end of last year, I was noticing some of the trends in factory orders saying like, this isn't a good sign for manufacturing activity overall. And so the white line here is just non-durable goods, orange line, durable goods orders. And both of them have been basically flat over the past several months. And in fact, you can go back to like the third quarter of last year when this kind of stalling pattern emerged in factory orders. Like before then, orders growth was very strong. Businesses were investing more, and that helped drive an awful lot more orders. But since then, it's basically stalled out, and that's led to just like this weak performance in manufacturing activity overall. Now, I would draw a little bit of attention back to where orders were, say, back in 2016. During the last sort of freight recession, orders were tumbling quite a bit, and that hasn't really happened yet. The growth has kind of stalled out, but it hasn't collapsed like you would have seen in the 2015, 2016. But yeah, definitely some softening in those kind of trends in recent months.
So you're not seeing it the pressure isn't decelerating. You're seeing it sort of flat.
Yeah, I mean, and my basic take on it is basically once the tariffs and trade wars kicked up, in the third quarter of last year, businesses were just like, we're just going to hold off on investing in things.
It's interesting because I read a lot about the tariffs, and you've talked a lot about it, is that actually the cost inflation has not shown up in the numbers, as I understand, is that consumers, that those costs are actually not, because of currency and other issues, are not being passed off to consumers in terms of additional tariffs. But what is happening is this business capital investment and uncertainty that seems to be stressing people out.
No, absolutely. And in fact, when the tariffs were initially announced, I think I remember saying something to the effect that like tariffs aren't that important in the grand scheme of things. Like when you actually play it out, because the export sector is only 15% of the economy, and you have currency effects to kind of offset some of these things, like the impact directly for tariffs is pretty small. But you worry about these spillovers, like what it does to business confidence, what it does to investment, and how that plays out in the economy. And that's certainly been the way it's manifested this time around. In the labor market, labor market's been pretty steady.
We don't need to spend a lot of time on that.
Yeah, exactly. The unemployment rate's low. It's been low. There's been some general softening in the hiring numbers. Like I think it's pretty clear that like the pace of hiring has ticked down a little bit in 2019. But it's still strong by any kind of historical metric. It's also faster than the labor market tends to expand. So I think things are still all pretty good on the labor market front. Wage growth is good, unemployment is low, job growth is still pretty good, and so that those are good fundamentals. And typically I look at the labor market in terms of how it relates to retail. And since the labor market conditions are generally pretty good, retail has also performed pretty well. Now, the pace of growth in retail is definitely downshifted. Like last year, you were seeing growth rates about 6% or above year over year during the middle parts of last year. We're not seeing that. Part of it is comps alone. You're just running into more difficult comps this year than you were last year. And so as a result, the growth rate has ticked down some. It's kind of fluctuating between 3 and 3.5%. But again, I would generally characterize retail as being fine overall. Like consumer spending is fine. And most of the consumer fundamentals look pretty good. Now, within that, even with all that strong growth, you really haven't seen any uptick in hiring in retail. So this is retail employment and the trends in retail employment. And you can see like even last year when you were seeing growth of 6% year over year in retail sales, retailers weren't hiring any more people than what they were previously. And so far this year, you've actually seen retail employment die down. That even though overall hiring in the economy looks pretty good, retail employment is not doing well, and so you're starting to see more layoffs from retailers, businesses shutting down, and things
So
like
I got to
that.
ask you a question. If they're in the warehouse and the retail employment, are these people that are at the stores, or is it for companies that are in retail?
So it's for the physical locations.
So as the mode shifts, if you see retail sales up, but you actually see the retail employment down, it suggests that that's just uh, a shift to a different type of
Oh,
product.
absolutely. In fact, you're stealing the punchline.
sorry. I didn't mean to do that to you.
But yeah, basically that's what it says is that retail sales is doing well, but it's not these kind of traditional brick and mortar channels that you might be used to, right? And so it's not the physical location that's enjoying this rapid growth in sales. It's different modes that the retail
So we
activity
saw
is
it
taking
peak in
place.
2017. It was
Oh,
the end of the cycle. And have we seen peak retail, you think?
I don't know. I mean, the thing about retail is I think it's still evolving.
Mm-hmm.
Like retailers are still trying to get a good handle on what the best solution is for the interaction between in-store and online.
Right.
And so, as they do that, they come up with different ideas, like maybe you buy something online and you pick it up in
Mm-hmm.
store, or how that's all going to work. And I don't think that they've necessarily settled on like this is
I
the
don't know
new
they
way that
can.
it's
It's
going to go.
happening so fast. I mean, Barney's, I guess, is filing bankruptcy in New York
Oh yeah,
because they couldn't afford the rent doubled on them,
oh
and
yeah.
they had to pull out. I mean, I think it's 33. It went from 17 million to 33 million a year. So.
Oh, and I mean that actually brings up a pretty interesting point that retailers these days get squeezed on all sides from their
Mm-hmm.
margins. For one, you have this idea that like rents are increasing and things like
Well,
that.
high quality urban real estate where you would want to be have a retail storefront
Yeah.
is actually exponentially more expensive than
Oh
it
yeah.
has been. Whereas the mall, where you don't want to be because there's no foot traffic,
Yeah.
it's tough for them to keep
Yeah.
stay afloat.
And then on the other end, like they don't have the same pricing power they used to have.
No, because you
Because
can
you can
shop, and the mobile phone has destroyed it. That's
exactly.
everybody predicted that it was the online.com, but it's actually the mobile phone.
Yeah,
That's
exactly.
actually is doing it again.
Yeah, and so as a result, you're sort of seeing in the employment numbers that it's really not these brick and mortar. I think still is under quite a bit of pressure, and the real benefit from all of that is just e-commerce performance. So this is electronic shopping and mail order sales. That's not exactly e-commerce, but it's the closest monthly number that the Census Bureau puts out on e-commerce. And the growth has been, I mean, it's one of the more steady areas of growth in the economy is just e-commerce. That even during like periods where the overall economy isn't doing so well, where retail isn't doing as well, you still see kind of double-digit growth in e-commerce fairly
Are we
steadily.
just ignoring that dip and assuming that's government shutdown?
Yeah, I mean, it's it's only 1 month anyway, so it really doesn't make any difference one way or another. I mean, it's a
It
little
continued. The line continued right where it started.
exactly, and so it's like some kind of anomaly that happened in December, and then by the time January numbers come back, you're right back to double-digit growth. I do feel for the people that have to plan for like December
The
volumes.
comps, although
Yeah,
the comps are going to look really good.
no,
Actually.
exactly. So
Yeah.
expect 20% growth or
Yeah.
something like that this December. But otherwise, I just kind of write it off as an anomaly. And I mean, you can actually see that e-commerce growth is it's actually picking up. Like it's been better this year than it was last year,
Mhm.
even though the retail growth isn't as strong as what it was last year. So you're seeing actually stronger e-commerce kind of growth emerging out of the
I
economy.
wonder if that's just the speed and the ubiquity of getting everything faster.
Oh yeah,
Like it's just so much faster. Than it
yeah.
used to be.
So yeah, some interesting dynamics, and I think it's important for freight because the logistics of a brick and mortar kind of operation are quite different than when you're dealing with e-commerce. Like e-commerce is much more heavily focused on the parcel companies, the LTL companies. Like they get bigger benefits there, and just the way that the whole supply chain operates quite a bit differently in that environment. On the housing side, I mean, housing has been generally weak over the past, I'd say, year and a half, like really since the start of 2018, when it looked like housing might be gaining some momentum. Housing has been pretty consistently disappointing. The housing start numbers have been looking a little bit better recently, but still negative year over year. And I don't expect any kind of significant acceleration in housing as you go forward either. Like housing has some supply challenges. One that they have a hard time finding labor, and they also have a hard time finding like lots for to build on. And these kind of constraints are going to keep any kind of more robust rebound in housing in upcoming quarters also. On the trade side, I think it's pretty clear that import and export growth has downshifted quite a bit from where it was last year. I mean, consider at this point last year you were looking at like 10% growth in both exports and imports year over year, and now you're looking at export growth that's slightly negative, import growth that's slightly positive, and really it's I just like I consider it just fluctuating around zero. Like it's mostly comps that make things slightly positive and slightly negative now, because there were a lot of tariff-related surges at this point last year, and so I don't expect. I think that the trend is pretty clearly down here for trade. I think as you go forward into the second half of the year, these numbers are going to probably be more clearly negative. Instead of just fluctuating around zero, I think they're going to be pretty solidly in negative territory, especially on the import side. If you remember last year in the fourth quarter, the third and fourth quarter, there was a pretty big surge in imports coming into the country to try to avoid some of the tariff hikes that were set. And as you get there, the year-over-year growth rates are probably going to turn negative.
And I was talking to someone who studies political elections, and the theory is that now that we're in an election cycle, is that tariffs that Trump probably, who knows, probably won't pursue an aggressive trade stance.
Yeah, I mean,
because he's going to be so distracted with all of the frontal assaults coming from.
I mean, common sense would probably lead me down the same thing.
You're not going to put your money on it.
Well, I mean, I've been burned by it before. I remember for a long time just kind of believing that all of this was just temporary anyway, because it doesn't make any sense.
But we might be stuck with it. The other thing is we might, because of the same reason, is that we might have these Chinese tariffs for a period of time.
Mm-hmm. No, absolutely. And so I just kind of take it as it comes now. Like I'm just like, whenever they change stance, then I'll change my outlook.
Who knows?
Until then, I leave it how it is. So in terms of risk areas for growth, going forward, I think that one of the key things that I'm focused on right now is just the state of the global economy. There's some trade war aside, there's some real challenges in the global economy. So China's been on like just a general decelerating path for several years now, and it looks to have resumed over the past couple of quarters. And so that has significant downward pressure on overall global growth conditions. And then also, I don't know how much you pay attention to what's going on in Europe.
Hong Kong. Oh, in Europe.
No, in Europe, it just with Brexit and everything. But it's turned out to be a very messy situation, and the likelihood that sort of Brexit kind of occurs without any kind of deal in place to replace it, or to govern the terms of trade.
They have a new prime minister, or at least when I don't know what the transition period
he actually starts today.
He starts today.
So Prime Minister Boris Johnson,
and he was the one
today.
that sponsored he was really the Brexit champion, was he not?
Oh yeah, and he also said in this whole process that he was determined to go through with Brexit with or without a deal by October 31st. So the likelihood of that is pretty high. If that happens, it's probably going to put the UK into recession, and there's a good chance it pushes Europe overall as a region either into flat growth or recession. So just and that has significant downward just negative effects for global manufacturing trade, and you can kind of layer tariffs on top of a very messy global situation as it is, which will make things worse. So trade policy, sort of connected to that loosely, we managed to avert the tariffs that we were planning to implement against Mexico, and I talked a bit about how I think in a sense the damage might have already been done just by threatening tariffs against Mexico, because we didn't have any trade difficulties with Mexico that we were trying to address, and we also sort of implemented another ceasefire with China. Like we called off escalating the trade war for a time being in order to negotiate. So some positive news on that front. But at the same time, there's threats of new auto tariffs on European imports. And there's just this general cloud of uncertainty that's hanging over everything. And, when I talked about the factory orders, I said basically it's part of the reason why factory orders have kind of stalled out. And I think as long as you're in this environment where there's this cloud of trade policy uncertainty, it's going to be hard to imagine just like any robust acceleration in business investment or manufacturing activity along with it. I actually kind of think that it'd be better if we just had a definitive ruling one way or another on
They
tariffs.
said 25% across the board.
Yeah, I mean, even if whatever it is, you just say that this is what it's going to be and be done with it.
I think that the challenge is that mitigates sort of the back pocket negotiation, right?
No, I know. I mean, I understand
the art of the deal.
I understand from a negotiating standpoint what they're trying to do, but from a business planning standpoint, you'd be better served to know what the terms are going to be and then plan around it. And so that's another area of risk. On the upside, monetary policy looks increasingly dovish. Like the Federal Reserve meets again at the end of this month to talk whether or not they're going to, what they're going to do with rates. I think it seems pretty clear that they want to drop rates in this next meeting. Like I'd be surprised if they don't. I think the question really now is number one is how big of a rate cut they do when they cut rates, and then how prolonged of a rate cutting cycle you're going to be on. Like is this the start of just like a series of rate cuts? Is it going to be just the one rate cut and you're kind of settle in there? But at any rate, I think it's positive from a growth perspective. The bad news is the economy probably doesn't feel the effects of that until the end of the year, the beginning of next year. Like rate increases, decreases usually take some time before they take hold in the economy overall.
And the stock market and the future, you're talking about this in a second, yield curves.
Yep. So a little bit connected to that is the yield curve. This is actually one of the other areas that I'm particularly concerned about. Is that the yield curve inverted over the past month or so? Like it basically inverted in June, and it stayed inverted for a while. The yield curve actually inverted earlier this year, and in fact, I think we talked about this on one of the webinars because it briefly, inverted and then kind of went back to a more normal relationship. But this time around, it's been quite a bit more permanent, and it's one of the more reliable recession predictors that we have in the economy. So here I have the bond yields for the 10-year bond, which is the white line, and then the 3-month bond, which is the orange line here, right? And, typically when you think about the yield curve, like the longer the term, the higher the interest rate should be. Like a normal functioning yield curve says, if you're going to be loaning money for a longer time, you command a higher interest rate for that. And usually when there's an inversion, it means that the opposite sort of occurs, that something that's longer term actually gets a lower interest rate. Usually that means that basically the bond market players expect that there's going to be future rate cuts, and so that the interest rate in the future is going to be lower than what it is in the past. Now, historically, the reason why you would have lower interest rates in the future is because it means that there's like an economic downturn coming. And so most people say the reason why it's considered a good predictor is because it's a good sign that the bond market players believe that there's going to be a downturn in the future and that the Federal Reserve will cut interest rates. And one of the reasons why I like the yield curve as a predictor is because it's like a symptom, but it's also a cause, right? Like it's a sign that this is what people believe is on the horizon. But also having an inverted yield curve has tangible economic effects. Like if you think about what a bank does, like they basically borrow short and then they loan long. And if the interest rates are inverted, then all of a sudden that incentive to loan out is gone, and you start
tightening up credit.
Exactly, you see credit tighten, and this actually pushes the economy into recession.
And we've seen. I mean, it may be this, but it's other things happen as well. But some of the trucking the banks that have tightened up their underwriting criteria for the trucking industry. I mean, we're hearing that as well.
And so do I think that like a recession is imminent now? I'm definitely concerned, and I would say,
are you moving to the dark side?
No, I mean I do worry about it. Like you hear a lot of people when these kind of things happen that say, well, it's different this time, and every time the yield curve inverts, there's articles that get published that say, well, it's different this time. Now there's decent reasons to believe that it actually is different this time. Like the way the Federal Reserve operates now is different than what it did the way it did 10 years ago. Like the Federal Reserve right now, when they're talking about cutting interest rates, they're much more preemptive about things. Like they're clearly saying like we're a little worried that the economy might slow down
signaling,
in the future.
Right? They do a lot better job of
exactly. And so as a result, you might not take the yield curve as being as indicative of a recession on the horizon as possible. But again, I've heard these stories about it being different this time every time. That there's always an explanation for why it's different this time. And so I would say recession odds they're probably higher than normal. I'm not necessarily forecasting a recession, but I would say the probability of one is probably like around a third or 40%.
You're at 40%, and over the last couple of times you've done this, you're in this, well below that.
Yeah, I mean, I generally operate every year with maybe like a 15 to 20% chance that we fall into recession. Like no matter how good the economy is doing,
you're an optimist.
I could say like there's probably like a 15 to 20% chance that you fall into recession. And so I would say relative to that, it's probably like twice as high as what what it normally is. It's not the baseline case. It's not what I would say for sure. But I'm definitely concerned about this kind of thing. So on the supply side, just taking a look at trucking hires, the last employment report was actually pretty positive for trucking hires. I mean, it showed a month-to-month gain. It also had some pretty positive revisions to previous data. And so, like, instead of having just completely flat hiring numbers, it now is like a slight positive slope to it since the beginning of 2019. I would say, regardless, you're still looking at a pace of hiring within the industry that's clearly slower than what it was in 2018. And I think the overall conditions within trucking suggest that it's more likely that you see a reduction in payrolls than any kind of reacceleration.
Well, I think this is an important point, that what I'm hearing is the larger carriers, and I mentioned this earlier, are having success filling their trucks. There are carriers talking about being fully seated, which means they have a driver assigned to every truck. In fact, I've heard some of the carriers are actually thinking about growing or are growing their fleets because they're able to get drivers at a pace that they haven't seen in the past. But then you talk to other carriers that predominantly operate in the spot market. And I talked to a carrier yesterday, they had 150 trucks last year. Now they're down to 75. They've churned through about half their fleet because they operated predominantly in the spot market and can't keep the trucks running.
Yep.
And so I think what's happened is a flight to quality. So that employment number, if you divided it between larger carrier and smaller carrier, may be more reflective of, you see some growth in the larger fleets and smaller growth or downsizing in the smaller fleets.
Sure. And on top of that, just keep in mind that like the BLS numbers aren't going to capture like independents.
Yeah, for sure.
Like they'll capture smaller companies. They won't capture people that don't have payrolls. Right?
Well, I talked to some insurance carriers. So there's an insurance company here in town that does small fleets. They're all small fleets, and what they said is they're actually over 10%. So they look at renewals.
Mm-hmm.
The amount of trucks that are being renewed have actually dropped up by over 10% in this renewal cycle starting in March.
Yep. And so all of this, if you take the combination of demand that I think is either flat or slightly declining overall, and capacity that expanded quite a bit last year, it all puts downward pressure on prices. And so this is producer price index data by industry, and the year-over-year growth here, right? And so the white line is long-distance trucking, and you can see sort of like the growth rate for rates has tumbled from over 10% year-over-year to like about 2.5%, like slightly over 2.5%, and it's falling fairly quickly. And the comparisons get more difficult as you get into the second half of the year. I expect that this reaches zero or turns negative pretty soon. And so the idea that you start to see negative year-over-year rates on the long distance side, I think is very likely. On the local side, it's been a bit better. Like the local rates held up quite a bit better at the beginning part of the year. Tougher comps has pushed down the year-over-year growth recently, and LTL has also done a little bit better than say what you would find on the long-distance trucking side.
All right, so we're going to dive into the freight market update and talk a little bit about Ibrahiim. Thanks for the economic information. I'm going to talk a little bit about what we're seeing in the market from a freight standpoint. So this is our OTVI index, which is proprietary to FreightWaves. And this is comparing the 2018 and 2019 numbers. We've talked a lot about a number of times, whether it's on our sites or even on this call, is the difference of May in 19 versus what we saw in 18. We saw a dramatic drop in mid-month, which is abnormal. So one of the things that people like to say is you can't compare 18 versus 19. And what I like to remind them is what really caught us off guard was that significant drop in mid-May, which really, if you look at it on a market-by-market basis, seemed to be really port and tariff and trade-related is where we saw the drops off. And so the market resumed. We had, if you look at June's numbers, we did have a pretty sizable drop this June from where we were last June, about 5.5%. But what really sort of, you can see it, is the drop-off in the latter part of June happened sooner and faster than last year's drop-off. And also, it was a bit more aggressive and a bit more aggressive of a slump. It did resume, and we look in July, we're seeing the bands start to come together. And I think it's really just a matter of comps, is that the July comps of last year, we're getting into a period of the market where things were, it wasn't apparent to the freight market, but we were seeing it. Things were slowing a little bit last year. And so as we move forward through the rest of the year, comps are going to become relatively easier because we're past the peak cycle. And so in terms of what we're expecting, I think as long as the broader U.S. economy holds up, and I think you're the expert there, then it could suggest what's going to happen for freight and freight volumes. Moving into getting into ports and what we saw around ports is that if you looked at the freight market over the last, really the last year, the ports have been driving most of the activity. With what's been happening in the port of Newark and in Los Angeles, those are one of the largest ports, or the largest ports in the United States, is that they're still pumping volume. We talk about tariffs dropping off, but they're still actually pumping substantial amount of volume. So we haven't seen that really drop off, except for that mid-May slump we referred to. And we have seen more activity actually in the Pacific Northwest, is actually as it's been harder to move and shift demand because of the threat of strikes and other things at the ports. The Pacific Northwest has actually been doing well, less delays and such. Vancouver, the port that is in British Columbia, is actually getting a substantial amount of volume that's really shifted from the United States because of the threat of strikes at the ports there. So looking today specifically at the state of Washington, the Pacific Northwest, it's actually doing better relative to where it's been over the last couple of months, specifically related to produce. So one of the things that we saw was that there was a lot of refrigerated demand coming out of the state of Washington, and that is specific to the produce season, which we didn't see much of so far this year. If you look at the inland market, which is really the core part of LA, Chicago, and Dallas, that section of the country that is not directly touched by ports, is volumes continue to be softer than 2018. And I think as you think about why that is, if ports have been driving the part of the market and manufacturing soft, then probably what that has held down is volumes just out of those markets, because those markets specifically not only get a lot of imports of activities through rail and intermodal, they also happen to provide part of the core manufacturing part of the country, and they're just not seeing the level of activity that they have that they saw last year. Moving into spot rates, one of the things that we study is really long-haul spot rates. It's important to know that these spot rates are really related to specific lane segments and specifically related to the long-haul rates. And so what's interesting about that is that the rates as is related to this year is comp to where we were in 17. But what's missed in those numbers is that costs have increased. I talked to a carrier this week that said that their driver costs in the past 2 years are up 28%.
No, I mean, if you think about, like, if you buy the narrative that, like, last year carriers were trying to add drivers, one of the ways they did it was by increasing their wages, right? Like, you raise pay, you add bonuses to try and attract drivers, keep them, and it's hard to take those wage gains away once you give them out, right? And so as a result, you just end up with higher costs for those kind of things.
So it seems to be that we're pursuing sort of a 2017 spot number in terms of where the actual market's at. But again, to the point we just made is that the costs are much higher. So your variable and fixed costs are higher, which means the ground that you would normally make up in even a peak is more muted because less money's falling to the bottom line for the carriers. And of course, Hurricane Barry, while the first major named storm of the year to hit the U.S. Domestic coast, really had no impact on rates. Just suggesting it was a smaller storm than what could have been, and B, it had no discernible impact on rates because there was just enough capacity to provide relief supplies. Looking at oil, because oil is a significant driver of both cost elements in the freight market, as well as now as an oil producer, as a major oil producer, we are heavily influenced, volumes are heavily influenced by the state of oil. What we're actually seeing is that production is starting to, it looks like it's starting to slow down. Is that when we had this dramatic drop in oil prices over the last couple of months, that's actually taking out some of the speculation in the market, and perhaps capital expenditures are not going. I don't think anyone wants to repeat the cycle of 15 and 16, where a number of those oil production and speculators actually went bust. There was a big overhang, and I think people are being a bit more cautious on how they treat the oil markets. And there's a lot of things geopolitically that are also concerning. OPEC did cut production, and that still has not really put a dramatic increase in price. Even, if you think about Iran, I mean, look back to in a normal year, if this was a couple of years ago and we've had what's happened in Iran, oil isn't seeing the dramatic pops that it has in years past, because everybody knows that the U.S. is the marginal producer.
Yeah, I mean, it's one of the things that's drastically changed about the U.S. economy is that an oil price shock or an event like that was one of those kind of shocks that could really affect the performance of the economy. And sort of the emergence of the U.S. energy sector has provided a pretty good buffer against that kind of thing. And I think it's starting to reflect itself in the prices that you see.
And one of the things happening in oil is that the retail fuel market, the diesel market, one of the things we track is the spread between wholesale and rack and retail. So we track each of those indicators separately. But the one I like to look at is the actual spread. The spread did accelerate. So the spread's the delta between the rack price that the truck stops are paying or is assessed at versus the retail price, and it lets us know how much margin is in the fuel market. And so if you look at it from where we were at, is we actually had an acceleration in that spread at the end of the fourth quarter. So a little bit of pickup at the end of this past quarter, the second quarter. But we're back to really where $1.01 is the spread. Now, in fairness, taxes are not in that number. So it's actually before taxes. So we've seen, I think, 8 or 10 states increase their diesel taxes this past July or on July 1st. And so that number at $1.01 is probably a little higher than actually the margin is in the market than where it was. So it's important to watch that, because that tells us a little bit about the sentiment in the market as well as the margins for the larger carriers. Moving into national tender projections, this is the one that really we should all take pause with. It's as low as it's been all year. You can see it flattening out. I mean, this time last year, in terms of projections, we were over 20%. Now we're actually still at the bottom, and we're back in July at the bottom. So I think when you think about what you've been talking about in the economy, and you think about all of the factors, whether it's increase in driver wages or increase in fuel cost, it's going to put a lot of these marginal carriers under a significant amount of pressure. We may see more bankruptcies happen in the third quarter. And I actually think that's what will happen. So one of the things we did was, and we've got this study that's live through Sonar users, is what is causing bankruptcies? What's the number one cause of bankruptcies? And it's actually accelerating diesel costs. That's the number one predictor of spike in diesel costs for trucking bankruptcies. And so Michigan State, in partnership with our Intel group, actually studied that and really looked at the fact that what causes the most exits from the industry is actually spike in fuel prices, more above everything. And this is actually in the report. You should read the report if you haven't read it, because it's really, really good. It's real solid work. But basically, it's the biggest failure of trucking failures is related to diesel, and they cluster. And so you can actually, if you start to see failures happen, they cluster around it. Diesel seems to be the big trigger. It looks like carriers, because a lot of the pricing they have different ways of managing that. It's actually the diesel price when it spikes on them that hurts them the most. If you look at just in terms of where things are at, coming out of the holiday, capacity loosened up. It's still very, very loose. Reefer, which is, if you look at Martin's earnings report, which is a refrigerator carrier, actually did exceptionally well. So they had a really good second quarter relative to the rest of the market. It has fallen pretty quickly. Van rates van capacity has also fallen. And of course, van rejection rates are at a low at 3.82. So it's lower than it was even in April. Moving into agriculture, because just looking at produce, is we didn't have much of a season this year. It really did not help.
Yeah, I know. I mean, the weather events in the early part of the year, I think, destroyed a lot of activity that would have normally taken place.
Yeah, I think it's been a tough year. Although I think the dedicated or committed refrigerated business did better than most when you look at the data. But certainly, we're unlikely to have a big growing season this year, and it didn't have a big impact on spot rates. Moving into intermodal, intermodal rail volume is down 6% year over year. It's interesting to watch the delta between the trucking spot rates and intermodal and the interplay there. It's actually been cheaper to move it by truck this year in certain markets than it is intermodal door to door. And because of that, there's been a gain share for truck that's taking freight off of the intermodal lanes. And so that's been interesting to watch the dichotomy there that you typically don't see. Looking at air freight, because air freight's really a sentiment of tighter supply chains and also certain types of commodities. I think this is really reflective of the global economy. You were mentioning Europe and sort of the fact that Europe is really stressed right now economically and seems to be teetering. Is that there just has been a lot of stress on the export market and the European economy, even as it relates to air freight rates. Air freights are down 30%. It also might have something to do with just the belly cargo capacity and what's available there. And you're also seeing it out of Hong Kong. North America is off by 11%. If we're looking at where we're at today, what do you think in terms of the later part of the third quarter and peak? Are we going to see air freight rates go up, or what's your thoughts there?
I don't know. I mean, my guess is that air freight rates are still, in terms of year over year terms, they're going to stay down.
They're going to be lower than they were last year.
Yeah, like, period to period, you might start to see like a pickup, but I still think you're going to be looking at something weaker than what you saw last year.
How much is the geopolitical stuff?
I mean, it's a pretty big part of it when you start to talk about just like air cargo and international trade. Like, I have a tendency when talking about tariffs to make them seem like they're irrelevant. They're not irrelevant. They're not that big.
It's not the cost side of it.
It's also for specifically the U.S. economy. They're not as relevant.
Mm-hmm.
But when you look in terms of just like global trade, I think they're pretty important, and that has a pretty heavy influence on air cargo performance.
So moving in, talk about international container rates. There is a GRI coming in, the general rate increase, that's going to increase container rates by a couple $100. And I think it's going to be interesting to watch because this IMO 2020, this new maritime standard for fuel, I think there's a lot of people speculating what that could do both on the international container market, but also on the domestic market. And there was an interesting article Greg Miller did this week about that you might see a shift from East Coast ports to West Coast ports related to this new maritime standard around oil. So or diesel, we'll bunker fuel. We'll watch and see what that does in terms of where things are headed. And again, I think the container ports have done relatively well, even in spite of that mid-May slowdown. They still have been driving the predominance of the U.S. freight economy, or at least keeping it going, even at times when manufacturing and other parts of the economy are been down. But it's interesting to see that New York and New Jersey are actually up. So is Savannah, and it looks like an East Coast story more so than the West Coast. Now that very well could be what the Panama Canal, or
maybe
you think that's what's driving it, or
yeah. I mean, I definitely think it's a factor. I don't know if it's big enough to for all of it. So just. This looks like your summary for the most part.
So the freight market is in correction from oversupply. I think the thing that we're going to watch is when do we hit the bottom? If I had to guess, I think in terms of rate sentiment, I think it's going to be a post-Labor Day deal. Mm-hmm. I think that's probably going to be around the bottom of the market. And that, I think it's going to depend. If the economy holds up in 2000 and going from the later part of 19 to 20, then we could see a situation where we could have called the bottom here in September or in August. But we'll see that. Volumes are off, but the gap is shrinking. Comps are getting easier. And then there's no current disruptions to the spot market, even with a hurricane, which just suggests that A, the hurricane wasn't as significant, and B, perhaps more importantly, there's a lot of flux capacity in the market. And then rates just continue to be down.
All right, guys, thanks so much for sharing. This is Marianne Hensley with our media team here at FreightWaves. We'll dive right on into the Q&A. So if you have questions you've not submitted, go ahead and do that right now through the Q&A button. First question, near the beginning of the presentation, you guys shared a lot of data around van. Do you have any data insights around what's happening with reefer?
Well, we do. So I think we talked a little bit about it. So the refrigerator market's really produce, or the ag market has really impacted reefer this year. But you are seeing some pockets of strength. I mean, like I said, today, the state of Washington, Pacific Northwest is doing relatively better because it's a good growing season. And I think where you see that, the Midwest, unfortunately, was just completely pummeled. So was California. The weather has really played havoc on the refrigerator market this year. But you do see, like I said, Martin had an exceptional quarter. And if you look at the TCA data related to the benchmarking business, it was a pretty tough April for a lot of the refrigerated carriers, but May and June were better relative to the flatbed markets. So I think the outlook for the rest of the year is that, if the weather seems to hold and we have a stabilization of the market, then I think refrigerated will perform better than some of the other sectors.
Right. And how much of a peak season should we expect this year? With manufacturing of goods staying flat, will that offset the peak of retail products?
I mean, I'll take it. I think it's going to be a bang up retail season.
Yeah, I mean, it depends on where you are in the retail space. Like I expect it to be a strong e-commerce retail season for sure. Like I think retail holds up pretty well all the way through the end of the year, and you end up with pretty good retail spending numbers. You're also going to get some pretty favorable comps this year for the retail space. And so I would say I think the holiday season is going to be pretty strong.
I would say if you have a lot of retail exposure, particularly what we call enterprise class trucking companies, I think they're going to do exceptionally well. I think also because there's going to be less capacity in the market than there was last year, and retail demand, assuming consumers continue to spend money. Yeah. There's no signs that they're slowing down. Consumers spend money. I think it's going to be a bang up year.
Awesome. And as the yield curve has inverted again and most other asset classes are positive, do you see any price disequilibriums in the other areas that are up?
So I'm assuming this is sort of referring to stock market valuations and things like that. Disequilibriums. I don't necessarily feel like stocks are overvalued. I mean, if you've been paying attention to stock prices really since like the fourth quarter of last year.
Well, it's a dichotomy because it's the tech sector and the growth sector is doing exceptionally well.
Yeah.
But if you look at the industrials, they're not doing well.
No, exactly.
They're very cyclically exposed industries.
Exactly. Like I mean, so I don't necessarily think there's like any overvaluation there, unless you believe some of these tech companies are overvalued.
It's just I think it's a weighting issue with the indexes themselves.
Yeah. And the other thing is that like movements in stock from quarter to quarter are almost like right now they're entirely driven by either the outlook for trade policy or the outlook for monetary policy. Like as you get developments on that front, you sort of see stocks swing up and down, just hinging on whether or not like the outlook for global trade looks better or worse.
I think there's certain parts of the stock market that are doing exceptionally well, and it's growth oriented stocks, and then there's everybody else.
Great. And with regard to your recession talk, where do you see potential bubbles in the world economy?
In the world economy, well, for one, I'd clarify, like I'm not predicting a recession necessarily. But as far as the world economy, like part of the reason why China has like a structural deceleration is because they're suffering from several bubbles at the same time. Like they have an overhang in credit. There's an overhang in property investment in that economy. And they also have an overhang of sort of like local government debt, and they're trying to, and industrial capacity. So basically 4 bubbles coming out of China that they're all trying to work through.
And there's some geopolitical pressure. I mean, there's some political pressure inside the country.
Absolutely. I mean,
look at Hong Kong.
Luckily, like the Chinese, the leader of China doesn't have to get elected every 4 years or what have you. But yeah, so and that puts a significant like that deceleration has an impact on that entire region, because so much of the activity that comes out of that flows through sort of Asia is either sort of products that are going into China for further manufacturing to get shipped out to the rest of the world, or vice versa, stuff coming out of China that goes to another country that then gets shipped out to the rest of the world.
And is government debt, is that a bubble?
Yeah, so at least on the local government level, yes. On the federal, from a federal perspective, I think China still has like plenty of room, and in fact, they're in the process of trying to stimulate their economy now, because they noticed that their economy slowed down quite a bit, and they try to maintain like a certain amount of.
What about the U.S. economy? You think? I mean,
well, it's interesting. I mean, because when you think about the U.S. economy, like the last couple recessions that we've had have been caused by basically bubbles that have emerged in one area or another. And I don't necessarily see any significant bubble that's sort of on the horizon that's going to sort of collapse things in the U.S. economy. I mean, the economy has been pretty remarkable over the last couple of years in that it's absorbed quite a bit of shocks without falling back into recession. And it's become, in the process, it's become a pretty diverse economy. And so I don't necessarily see like anything that sticks out that says like, you guys need to watch out for this. It's going to be the thing that hurdles us into the next recession.
Great. And do you guys think the closing of some carriers could be the reason for the influx of drivers being hired?
Absolutely. I think it's two things. It's closing, but if you look at the closing numbers, and I wrote the article that said apocalypse because it just play on the terms retail, and certainly we're not apocalyptic. But it's certainly that drama drives interest in it. The story of what's happening. I think for certain small carriers, it is apocalyptic, and they're suffering, not for the broader market. I think more importantly, I think if you're a carrier that can keep your drivers running, and where you find those carriers, the ones that have that more consistent freight, that quote unquote contract freight or consistency and dedicated, they're not having the driver shortage or the driver squeeze, if you will. And that's what's creating a flux of it. I don't think it's necessarily bankruptcies per se, because we were seeing them. They're certainly going out of business, but you're talking 2,500 drivers in the big scheme of things. That's not what's causing it. There's a flight to quality element here where drivers are looking for places that can keep them moving and can give them, income and give them a quality of life that they're looking for. That's already related to miles. And so there is a flight to quality. The drivers that a year ago were talking about they want to be independent and screw the big carriers because we don't want to work for them, are now finding comfort in working for some of the larger carriers because they can keep them running. And that's just a fundamental shift in how they're thinking.
Yeah. And with 2019 being a softer market, do you guys believe the 2020 truckload market will be even softer than 2016 truckload market, with it being an election year? Historically, election years have been softer markets due to the uncertainty of the future. So coming off of all of the uncertainty around the trade war combined with the election year, what does that potentially look like?
We've had a pretty uncertain 4 years. So I don't know. We're sort of used to it at this point. I'll take it and I'll let you do it on terms of that. I think if you're a carrier, if you're a trucking company, you own assets, I actually think 2020 is going to be a pretty decent year for you. Because I just think a lot of that softer capacity is soaked up and you're not having the pressure on drivers. I think your driver turnover is lower, and I think you're going to have a better sort of conditions to run. As it means for the broader market, Ibrahiim, you want to take your view on that?
Yeah, I mean, my general view over the past couple years is that the trucking industry and the freight economy was hit with more demand than it knew what to do with last year. And as a result, it kind of overextended itself in preparations for 2019. And so they kind of went out and they all bought new trucks and they went out to find more drivers and expand their capacity. And then they realized that the demand wasn't there. And so 2019 is a little bit of a correction from an overreach.
I hate to say this, but if you're an asset-based carrier and you're doing well, in many ways, you're hoping that the spot market you hope that downturn is pretty painful. And the reason is that you want carriers that had grown deep into the spot market and didn't have high quality operations. You want them to feel a bit more pain so they're not buying into the fact that it's easy to get into the industry. Because really, almost anybody could have made money last year. Almost anybody, if you just knew how to use very basic functions. This year, it's a very different story. And I think if there's more pain in 2019, that's probably more favorable for carriers moving into 20.
Yeah, and as you go into 2020, I don't know. I kind of feel like it's an industry that's trying to find its equilibrium a little bit, and so as you go on, you'll get a little bit more stability than what you've kind of seen over the past couple of years.
And the last thing I would say is the one thing we don't know, and it's nearly impossible to find out, is how much of this freight is running on these private retail e-commerce networks like Amazon and Walmart. How much are they really, truly putting and taking taking demand off of the for-hire market? Because we know it's a factor, but we just don't know because they're not transparent about their numbers. We just don't know how much.
It's actually one of the reasons why it's such an important shift that you go from like traditional brick and mortar to e-commerce, because really, when you say e-commerce, it's almost like a code word from like Amazon, a lot of this stuff.
But it favors the certain types of carriers in those markets. It favors the owner operators that are going to run under that almost nearly exclusively. And it favors the large asset carriers that provide certainty in their capacity maps. What it actually dramatically impacts is the spot market carriers that take transactional loads that aren't fully contracted.
Awesome. Well, we are just past that 3 o'clock mark. So thank you to Craig and Ibrahiim for being here. Thank you to all of you for listening in and for so many questions that came in that we did not get to. We will follow up with you after this via email if you provided your email address when registering. Don't forget to join us in Chicago, November 12th and 13th for our FreightWaves live event, where you will hear insights like these and so much more. For more information, visit freightwaves.com/events. Thank you all for being here. Have a great afternoon.